So if we move on now to talk about something that we've touched on, but perhaps not given it the attention it deserves, regulation. I mean, it's probably fair to say that transaction banking is facing more regulation than it ever has done before. SEPA in Europe, Dodd-Frank in the US, Basel III for just about everyone. If I can start with you, Peter, I mean, how big an issue and how big a worry is regulation for transaction banks at the moment?
I think clearly it's got to be somewhere near the top of everyone's agenda of things they're watching at the moment, and the risk for transaction banking is that you're being caught in the crossfire of regulation of banks generally. We've had something of, I would say, a phony war over the last 3 years or so, where there's been significant injections of support and capital into the financial sector, but as yet the regulation has not caught up, and the banks have not fully paid, if you like, what the regulators have said, the price that comes with that. And that's now coming very quickly with some of the things that you've mentioned, new capital requirements, new structural requirements, a variety of different requirements in different parts of the world. And that volume of regulation is enormous, and the speed at which it's being produced, in regulatory terms at least, is very quick. Even though it's been 3 years of phony war, actually, in terms of crafting this regulation and getting it right, it's very quick. And so the opportunity to identify fully and properly the implications, unintended or intended, on an area like transaction banking and make sure that the law works sensibly is actually an enormous challenge for banks. And at the same time, as you're doing all of that, you've got to look at where are the opportunities coming and how do I make sure I'm ready to capitalize on my particular structure and why I'm going to be favored by this regulatory change, or where are the opportunities because new customer opportunities are arising, like we talked about holding collateral for financial institutions, like we could talk about acting as a depository for regulated funds under the new fund regulation environment. Like we could talk about acting in some way and holding collateral for clearinghouses. A number of these opportunities. So there are a number of reasons why you need to worry about this, both in terms of guarding the negative impacts, but also not missing the boat on where the positives come from.
Sure. So is the speed that this regulation was drafted more likely to lead to collateral damage as far as banking goes?
Yeah, I mean, so I have the privilege of acting for the regulated rather than the regulator, and I don't want to be rude about them, but inevitably when you do these things in a rush, and the trouble is that the financial sector is in an unprecedentedly weak position to influence this regulation. The political stock is sadly very low for the reasons we all know. So these things come out very quickly with a political agenda, and the ability to shape them is limited.
And how hard is it just to keep pace with the amount of regulation that's coming out at the moment?
Well, I think certainly from a bank perspective, the effort involved in terms of systems changes and training of people is huge, and it's been a consistent role of activity. So the Payment Services Directive and SEPA in Europe, you've got Dodd-Frank in the US. All of these things have implications in terms of the way you do business, whether that's legal documentation, training, technology delivery. Some are more fundamental in terms of your systems than others. So we're all working towards delivering D+1 in Europe for the PSD from the 1st of January. And that means huge changes, not just to the bank systems, but for the infrastructures as well. So the ACHs and SWIFT and others in terms of supporting that activity. The one thing that, certainly from our perspective, what we try and do is, and Peter made the point quite well, I mean, we try and influence to ensure that what happens in terms of the shaping of the regulation is as pragmatic and sensible, still achieves the goals of the regulator in terms of what they're looking to achieve, but can be operationally delivered in a way that is sensible and efficient from a national or a regional perspective. And that's increasingly challenging. The whole point around consistency is not helped, even with PSD. It's a European directive, but the interpretation is slightly different in each jurisdiction, which means that if you're operating across a number of countries, you've got to adjust your systems to manage the local operational difficulties and issues as well.
I think that's an area where we'll see change. Increasingly, we're seeing now the Europeans wanting to make direct regulations rather than directives, which allow for that local variation. And that's a curious one, because in some ways that's good because it removes these complexities, might make it easier to deal in a cross-border fashion with consistency of regulation and so on. Particularly for new entrants who want to, arrive in a simpler landscape, rather than those who are already dealing with the complexities and sort of the incumbent, perhaps. But nevertheless, better for all institutions that there's less to contend with. On the other hand, who's making those uniform rules, and are they people who understand the business? We might say we've lived with regulators in the UK who, for better or worse, at least have some understanding of the banks that they regulate. They take the time to understand the businesses. We need to make sure if there are new regulators, entering the market at a sort of multinational level, that they're doing the same thing and that they're properly educated with what's going on. It's certainly something we're spending a lot of time on now, is helping our clients to educate the lawmakers and the legislators so that they understand what they're doing.
And I think that's the point, isn't it? It's not necessarily all the fact that you've got all these variations. I mean, you've always, in theory, always have had variations. I think that what is the concern is the potential inconsistencies, and many of these items get modified through the political process rather than the regulatory process, and so therefore you get sort of warts and all sorts of things on the side of these things. And I think no one really has a look over the whole thing and sees the effect of what one bit might do in one country, what another bit does in another country, and how that affects the whole piece. It's a bit like balloon theory. I squeeze it here and it goes up here. So I think that is the real problem, isn't it? So you do Dodd-Frank's in the US, fine. What effect does that have on something going on in Europe, and what effect does that have on the FSA here in the UK? I think no one looks at that by definition. It's impossible for anybody to do that one. And so the bank, of course, does have to look at that. You have to look at that because you operate across those jurisdictions. But otherwise, it could produce all sorts of unintended consequences.
I guess we certainly see that the FSA is certainly at the more gold plating end of the spectrum when it comes to regulation, which in a sense is strong, prudent approach, but does allow us to build our systems around the core, gold plating regulation, which does set us normally in a reasonably good place as those rules roll out. And it's interesting. I mean, one of the key areas that's impacting transaction banks at the moment is around the whole intraday regulation and how intraday is looked at. And here I think the FSA are ahead in terms of their focus, and also the Bank of England are very close to the market in terms of understanding what needs to happen. And I think what we've found is again one of the side activities around the regulatory piece is providing and supporting your clients through the regulatory change. And we found ourselves talking not just to clients but to regulators elsewhere in the world, talking about our experiences here and what we've done to support the intraday reporting in the UK, as a way of from our perspective not least helping our clients but also helping shape the regulation elsewhere so that we get some consistency.
Yeah, that's a good point. Another area where the UK are very much taking the lead is in the Vickers Commission, the Independent Banking Commission, which of course is not replicated directly anywhere else. It's sometimes referred to as being the UK's Volcker rule, but actually it's entirely different. And what that's going to mean for payment services and transaction banking generally, where you have, assuming that we, as the government say they will implement the recommendations, you've got a ring-fenced retail bank which is required to include all payment services within it, but is prohibited from doing business for institutions outside of the European Economic Area. So how do you provide global payment services? Certainly, you've got an obvious difficulty there. Back to the topic we were discussing before about globalization, the regulation almost seems designed to break that up. So there are a number of challenges coming out of that, I think.
It's interesting, though, isn't it? Because the regulation, whether it's looking to drive good bank behaviour or market reform in terms of robustness and efficiency, we can debate the degree to which it will achieve that, and there's a fairly heated debate around that, but it will cost more. And going back to the customer, ultimately, the customer will have to pay. And whether that's in the form of increased price of risk mitigation, either through hedging or trade finance, or indirectly because retail banking may well cease to be free in the UK, I'm not sure the impact of the customer cost has really been thought through of all the regulation.
Well, I'm sure it hasn't. But the political answer to that is innovation. And if one asks a regulator that question, well, how will that get paid for? The answer generally will come, well, you innovate in your service provision and there'll be new services. So far, that's been a bit thin on the ground as actual outcome, I think. But we shall see. But I do agree that regional variation through regulation is a big issue, and driving certainly. I mean, if you look at banks' budgets at the moment, there's very little discretionary spend left. It's all 90% driven by regulation in the different marketplaces. There are some sides where they do cooperate. I mean, the CPSS is a good example where the regulators cooperate to come together to a common set of things. But nevertheless, the room for local variation and implementation of that is quite high. Globally, this thing is a global standard, but if one actually drills into it, one could have very different regulations in different countries, and one suspects there will be.
So is there already a risk that someone elsewhere is going to have to give just to keep up with compliance and regulation? Or?
Oh, that's happening.
Yeah,
it's happening continuously.
Past tense.
I think what it is starting to force is innovation is not the right word, but I think more collaborative potential solutions. So if you look at one of the key areas that impact transaction banks, the KYC and screening activity around payments, which is a huge task. And again, this is a standard task which we all need to undertake. So the question about how we do that and how that might be done going forward is a challenge that says there must be a more straightforward way than us all creating our own industries to do it within our own banks. But that raises a whole set of different questions around liability in terms of the organisations. But also it comes back to the same nutty problem of consistency. So which standard of KYC do you align to if you're going to put this into a shared operating platform? And I know SWIFT have been looking at how they might do this, but again it's still going to come back to how you can align the regulators so that you've got the right level of standards that's consistent.
Yeah, we see this already in white labelled services where we were talking about before. You've got someone facing the customer on the front, perhaps the bank behind, doing a lot of the legwork. KYC is usually part of that. And if you've got multiple jurisdictions there, if you're based in one location and the party who's white labelling is somewhere else, where you've got to make sure you're meeting the requirements there too.
We need to be a bit careful that we don't sit around saying, oh, it's all just too much regulation going on, because partly that's just the way it is. There is this regulation, and partly it's some of it is good. In fact, quite a lot of it's probably good. The issue really is the unnecessary cost put into industry by the inconsistency and the room for variation, which leads to people spending money 2 or 3 times when they could actually do it once.
I think the other concern is always the risk element in terms of just the volume of change. I mean, it's a dialogue that we have quite regularly with regulators, which is you're asking for these 3 or 4 things, and they're all the dates all align. But this, when you look at it collectively, that's a significant amount of risk to implement these things in that way. And I think that's one of the areas where we do get quite a strong dialogue. But you're right in terms, Harry, of whilst not necessarily driven by regulation, you could argue self-regulation. But if you look at the UK with faster payments, I mean, we now have a system in the UK where you can make instant payments 24/7. And that sort of change in terms of the marketplace is quite a rapid change. I mean, that took 2 years to develop, and is down there being regularly used.